today's podcast, Jeff Moe and I start with a simple question. Are we moving from a more intangible economy back towards a more physical one? Jeff lays out the case for why growth may increasingly depend on building things again, whether it's data centers, grid equipment, factories, defense systems, even satellites, and what that means for investors. Along the way, we'll discuss how those bigger picture themes connect to bottom up research, where the US midcap team is finding ideas, and why there's no substitute for humility.
Great to see you again, Rob.
Well, let's dive right in. And I heard two interesting sound bites at some of our recent research team meetings in the last couple of weeks. The first wasn't from you. It was from one of our colleagues, Sandro, on our global credit team. And he reported that producing 1 unit of GDP today requires about a third as much oil as it did back in the 1970s. The second statement, though, was from you. And it was a thought that the economy might be entering a phase where there's a higher amount of CapEx needed per unit of GDP growth than we've had over the last couple of decades. And so, can we start there? And obviously, your two frames of references are a bit different. Sandra is really looking backwards, you're thinking forwards. But just help us understand the context for why you thought that was important to share with the team.
I don't think these two statements are necessarily inconsistent. I think oil is a very narrowly focused view on one type of energy. And it's true. I think statistically, if you look at the numbers, we do need less oil as a global economy to continue economic growth compared to the past. I think the rise of renewables, just generally a less energy intensive economy, has probably caused this math to be true. And in fact, it's the point of a less energy intensive economy that kind of brings me to what I said. So over the last, call it 25 years, 30 years, sure, whatever frame that Sandro is using, I think what we've seen is a rise in the intangible economy. So you had the internet boom, kind of started almost 30 years ago now. And also with that, the rise of a professional class. I mean, certainly it started before that, but kind of office workers as a percentage of the total workforce in most Western countries, I think is at or close to all-time high right now. You kind of had a lot of growth that was, call it, in the intangible part of the economy, intellectual property and services. And if you look at the lived experiences of many consumers, we are also consuming more intangible things, whether it be Netflix or social media or experiences like travel and so on. However, our belief is that could be changing, or at least the reason to kind of make physical investments is starting to get more compelling again. So the first one that is already kind of in full force is what we've talked about before with AI data centers being built out to support the kind of advancements in AI and excitement and kind of generally the boom in usage of AI across many consumers and businesses in the world. But I think there are several other themes that's causing the economy to become more of a physical economy, requiring more capital expenditures per unit of GDP growth. And so kind of
Well, let's get into those. And I'm thinking back to my Econ 101 days where economic growth is driven by labor, capital, and this productivity measure. I think if I think back to my textbooks, it was total factor productivity. What I think I'm hearing from you is that over the last, like you mentioned, let's say 25 years, whether it was the internet boom, there was just a lot that was driven by that productivity factor over the last little while in comparison to either labor or capital. And you're saying that now that capital might play a more central role in driving growth going forward.
We may be reaching some of the limits for kind of the Internet 1.0 era for kind of productivity improvement. And certainly, I think there's a lot of hope for productivity improvement from the kind of AI models and people harnessing them. But I would say capital is becoming more important because in many cases, you need capital to achieve those productivity improvements, whether it's a data center or something else.
Exactly. Yeah.
Kind
You
of,
mentioned there are a couple other reasons, though. Let's
yeah.
dig into
Let's go
those.
into those. So probably the easiest one is kind of infrastructure. We've talked about this for years and years as an economy. There was kind of the bills during the Biden era, IIJ in particular, that really help to kind of put more money, at least in the US, towards infrastructure. But I think a part of that infrastructure investment was recognition that there was underinvestment. But a part of it, I think, is also trying to reorient the economy towards a slightly more domestically oriented economy in the US. And so for the last 25, 30 years, there's a view of kind of outsourcing manufacturing, outsourcing kind of physical stuff from the US to China and other kind of lower labor cost jurisdictions. But now, whether it's kind of the rise of robotics, whether it's the COVID supply chain shock that caused people to realize, oh, maybe we need a little bit more productive capacity near to the centers of consumption, or just geopolitics, you're seeing more reshoring. And so, whether it's kind of building the infrastructure to support that or just straight up building more factories in the US, that's causing a rise in physical capacity. And it's not just the US as well. For example, in Europe, they're building kind of more battery factories, more auto supply chain, and more kind of defense supply chain or defense manufacturing companies in Europe as well. And generally, I think throughout the world, it could be a geopolitical reason as well, just more of a home bias to wanting sources of supply closer to the home country. Um, the next one kind of dovetails on
Yeah,
that.
bigger margin of safety. Yeah.
Exactly, yeah, bigger margin of safety, and just kind of generally not trusting the other guy that used to make it for you. Chips being a great example of that. The second one, it kind of dovetails to kind of that rising kind of tension within the geopolitical environment is defense. Whether or not these numbers come to be, the US defense budget is growing and increasingly growing at a rapid pace. NATO countries have made kind of this 5% of GDP commitment, even though they're kind of maybe fudging the numbers a little bit or kind of expanding the definition of what expenditures count as defense spending. Nevertheless, that's still going to cause a big drive in defense. Certainly, Russia is spending a lot on defense, and Ukraine, of course. China is also growing very quickly, and so just generally, the world is getting to be a bit more of a dangerous place. People are building more physical stuff. There's only so much you can do trying to kind of hack your opposition in a real war.
And that actually might be an interesting case study for your original statement, which is defense spending isn't the most productive way to spend to grow your economy. And it is quite capital intensive. So if your economy is going to grow, and if that's one of the areas that's driving that growth, it almost by definition requires a lot more investment.
I mean, the hope is you make all this stuff as a deterrent, and then you never use it. So certainly there is economic activity in the production of it, but it doesn't actually, unlike a road or something, it doesn't kind of add to your productivity of the economy. And one area that can add productivity to the economy is the space economy. We're seeing a lot more satellite launches on both spectrums, both the consumer side as well as the military side. On the military side, I think one learning from the Russia-Ukraine war is that signal jamming is a real concern in kind of modern warfare. And so a lot of countries are racing to develop more kind of what's called optical-based communication methods, where you kind of send lasers to a satellite, and then the satellite kind of redirects the message back to the ground again. Well, you need more satellites in space to be able to do that. And so kind of the major countries that can afford to do that are kind of pushing in that direction. And then obviously things like Starlink and other kind of low Earth orbit satellite constellations is becoming a big phenomenon, both because internet connectivity is seen as, especially in war, is seen as just really important, but also just people are realizing, hey, actually this concept of just blanketing the Earth with thousands of low Earth orbit satellites actually gives pretty good connection. And it's kind of additive to productivity, whether it's kind of remote connections or even I think most airlines in North America now offer Wi-Fi through a satellite provider. So kind of that there's just kind of more areas of productivity that people hadn't thought of previously. And all of this is driving a higher demand in commodities, maybe X oil. But I'm thinking things like copper. Copper is hitting, close to dead level highs now, I think. Maybe all-time highs, depending on kind of inflation adjustment. I haven't actually looked at the chart that far back. And several other kind of metals, especially you kind of call it more advanced metals, niche metals, are hitting kind of all-time highs, both in demand and price. Part of that is just the general need for that material and especially kind of advanced technologies. But a part of that is we've actually underinvested in physical commodities probably for the last decade, because we had a few different things that have caused the economy to not consume as many commodities in the last decade. The first was after oil kind of had its crash in 2014, 2015, when OPEC for a period of time decided to just pump as much oil as they could. That caused an industrial recession in the US. It didn't cause an overall economic recession, but it caused an industrial recession in the US. And that dampened demand for commodities. Around the same time, China started to reorient its economy away from an investment-driven economy to a consumption-driven economy. And that's still ongoing, and that's kind of has its bumps along the roads. But certainly during COVID, China, especially because they were one of the strictest lockdown countries in the world, that dampened the needs of their physical economy. And generally speaking, through kind of that 2015, 2016 era, all the way to maybe until 2022, when kind of supply chains really got kind of gnarled up. There was just underinvestment in kind of the physical supply chain, whether it's upstream actually mining or kind of materials processing or kind of the capacity to make these kind of intermediary industrial products like bearings or valves or transformers, any of these things. And so now, as the economy is starting to demand more physical product, you're seeing these kind of weird, huge discontinuities. Memory being the most extreme example, where the prices of DRAM or NAND memory is going up at like 40, 50% a month, like month over month, which is just insane price increases. I think this is probably the only time in my career I can think of I've seen the price of a product go up that quickly. Absent things like, weather spikes in natural gas or something that's kind of like very, very technical in nature. So I think this is a theme that could be with us for at least 5 years, maybe the next decade or two.
And it's interesting on your comment on memory. My understanding is that it's even changing the way that not just the pricing, but the way those businesses operate in the sense of just the types of contracts they have with their customers. Whereas it used to be just, go in and buy what you need. Now, because of the supply demand imbalance, there's a lot more longer term contracts that are entering into this, which potentially kind of smooth out some of the demand for some of those providers.
Yeah. Although memory, I mean, I don't want to overlearn there because it is an extremely cyclical industry even before the AI boom. And so it has its own idiosyncratic factors, and kind of these big price swings are kind of somewhat more typical for that industry. But I'll give you another example. We just, as a team, started analyzing a company in the electrical supply chain. So they make certain products that kind of go into the kind of electrical infrastructure, the grid infrastructure. And this is a company that's had, call it between 0% and 3% growth for the last decade per year. Margins are, pretty steady, kind of your steady Eddie kind of, GDP type growth, industrial company. And they they had about a 15 to 20% price increase on their main product in the last quarter. Yeah, that was a year-over-year number, not a quarter-over-quarter number. But still, I mean, for an industrial product that has generally just been a very stable, steady Eddie product for the last decade, that's a big price move, right? In a part of the economy that maybe you don't expect as much cyclicality.
We've done a really good job of explaining what led to that statement of yours. I do want to come back later to why you might be wrong, just to play the other side of it. But if we take it as, okay, this is sort of one of the big tides that we see, not just starting now, but probably started over the last couple of years, I want to ask you about a couple of ramifications. The first we've kind of touched on already, which would just be cyclicality. If we're in an era where um, capital spending investment is a greater proportion of GDP growth, should we expect more booms and busts as a result of that in a more cyclical kind of world?
Yeah, that's an interesting question. Um, I mean, I think booms and busts are more probably controlled by ultimately still kind of consumer confidence, kind of ups and downs. I mean, the last two kind of more severe recessions, so to speak, 2020 and 2008, was all due to consumers suddenly pulling back on spending. In 2020, because they were forced to by the government, essentially, and in 2008, because of just a sudden lack of confidence that they had no more wealth anymore because their mortgage is underwater and so on. So I think at least in the West, I still believe that's probably what's going to drive cycles. I actually think that capital-driven cycles, as long as it's driven by the investment in capital is driven by medium and long-term views on the productive nature of that capital, I think it'll be less kind of boom and bust. So I've heard my colleague Peter Lampert, who is head of our international equity and emerging market equity strategies, talk about this concept that, hey, some of these AI data center exposed companies, so companies that benefit from the build out of data centers, they're actually an insulator to if the economy perhaps goes in recession. For example, if oil prices stay very high because the Iran-US tensions cannot resolve, at least not very quickly. Maybe the fact that in many of our portfolios, we own some companies that benefit from kind of AI CapEx, that is a ballast for kind of other more economically sensitive parts of the portfolio, because the decisions that are being made right now by the hyperscalers and others is that we believe AI productivity is very high in the kind of the medium long term, and so we're happy to make these investments today and continue forward. So in some ways, I think the boom and bust could moderate because businesses tend to be a little bit more rational in investing. So another way to do your Econ 101 equation is consumption plus business investment plus government investment, like technically plus minus trade surplus. And I think the government and the business side tends to be a ballast to the consumer side.
Should we expect as well, with more capital expenditure, more investment, does that necessarily mean a higher savings rate that you need, maybe lower consumption? Um, Almost by definition, if you're saying that capital spending is going to be a greater proportion of GDP growth going forward, you're suggesting that consumption is going to be a lower amount. And maybe just to go to the portfolio, I've noticed that we have reduced our posture in consumer-facing businesses, and I wonder if those two things are linked.
Yes, absolutely. So we have been positioning our portfolio slowly as we find good ideas to do so, away from kind of a more consumptive driven economy to more of a building or productive driven economy. I would say that's less to do with the fact that we think in this GDP equation, consumption must therefore fall. Uh, Probably that's just,
Yep.
first of all, bottom up basis, some of these companies were looking less attractive. And secondarily, probability of a recession in the shorter term has increased. So some of that was driven by that. But I think if you kind of take a longer term view, it needs to come from somewhere. And the way it probably balances out is actually as corporations start to need more capital again, they will demand more capital. And so I'll give you a kind of great microcosm. The big four hyperscalers, kind of Google, Amazon, Microsoft, Meta, those four companies for years and years, and Apple too, although they're not kind of doing this kind of AI data center build out. For years and years, they had just huge amounts of net cash on their balance sheet. And while they still technically have net cash on their balance sheet, most of them are now raising debt in the bond markets. And if you kind of follow their CapEx plans for the next 5 years, they're probably going to have like a net debt balance sheet by the end of all of this. Each of these companies, I don't know what their cash balances were, say 3 years ago. Let's say they each had, I don't know, $300 billion of cash or something. That was technically in a demand deposit account at a bank. And banks now had that excess capital to lend out. Now, if you go from positive 300 billion to negative 300 billion, just those four companies alone, that's a $600 billion swing in the amount of cash available for the rest of the economy to borrow from. So as the demand for capital goes up, well, the laws of supply and demand, the price of capital goes up, so interest rates go up. And when interest rates go up, yeah, especially American consumers that many of them have a proclivity to consume on borrowed money. That has to go down. I do think you're right that long term, the economy shifts from a lower kind of consumer spending driven economy to a more industrial investment driven economy.
Can we connect some of these bigger picture ideas with the day-to-day bottom-up work that you and the team do in covering the US mid-cap space?
Yeah, absolutely.
Would it be fair to say that, okay, there's a bigger picture theme. Does that drive where you look for ideas in terms of what parts of the forest, what parts of the market that you're looking for investment ideas on a bottom-up basis within?
Yeah. I would say, yeah, at the margin, or I would say yes, it does. So I would say idea generation, the primary method at Mower is still always idiosyncratic. So we think something, we look at hundreds, thousands of companies, every quarter, even in some cases for like 10 seconds on a screen or something. And our primary criterion assessment is still, does this company look like it might have a competitive advantage? It might be a wealth creating company. Does it maybe have an excellent management team? Sometimes 10 seconds, it's hard to tell, but maybe there's a couple stats you can look at in terms of kind of consistent execution and things like that. And might it trade at a discount to intrinsic value? So I would say that at the core is still what I call idiosyncratic idea generation. It could come from any sector, it could come from any place. The idea, I mean,
And you're talking like the first cut of the universe, the
correct.
first
Yeah.
shot at, okay, there's 100 companies. Let's spend a couple minutes on each to figure out what are the 20 that I really want to dig into.
Yeah. Yeah. And I think that part hasn't changed and will never change. But I think if you come across after 2 minutes, you're like, company A looks kind of interesting, company B looks kind of interesting. But you read the business description of company B and you're thinking, oh, actually, this could fit kind of the theme or kind of how the economy is reorienting a lot better than company A. We then might bias to look at company B first. We might still end up buying company A because we end up looking at both companies. It's like company A after, our intensive analysis research is indeed the better investment
There's a
opportunity.
lot more diligence to go after that.
Yeah, so not
Obviously.
just 2 minutes of buying stocks. But the fact that in that instance where after 2 minutes, I think both of these companies are like, reasonably like similar in terms of their probability of us maybe ultimately buying it. We now probably bias towards company B, whereas in the past, maybe we didn't have a bias, for example. So that over time probably does shift you a little bit. And you can see it in our portfolio. We've probably been thinking about the defense theme for over a year now. And so a company like Northrop Grumman um, has been a kind of holding for us for a while. Some of the companies that benefit from the AI data center build out has made it into kind of core parts of the portfolio, most notably SanDisk, which well, it started as the peripheral part of the portfolio, but through its amazing performance has become a higher weight in the form of a top 10 weight. Or even a company like OSI Systems. They're the world's largest manufacturer of, call it border control or security scanning equipment. And they'll just benefit a lot from the movement of physical goods. A big area that they have growth in right now is cargo scanning at borders. And so as economy becomes more physical, just more stuff will move around. So those are some examples of companies that we have already kind of built up into higher positions in the portfolio. But I would say in the bottom half or the tail of the portfolio, there are several companies that we have found and identified that are just kind of more of the general industrial economy as well.
You mentioned robotics earlier.
I did mention robotics earlier, and I would say there's a couple of companies that we think has promise there. Um, but in those cases, their valuations today are a little high, so they're more kind of in the tail part of the portfolio. Robotics is still, I'd say, more of an emerging theme in the. I'm sorry, standard robotics isn't, but in terms of things like what Tesla is talking about with Optimus, kind of their humanoid robot. I mean, that's not in production yet, and kind of the true value add of that type of machine is still a little bit unclear in the economy. So some of those areas are still emerging themes.
You mentioned SanDisk and some of these other companies have done really well as this particular theme has been rewarded. There's a flip side, and the way I've heard you and others, and I don't even think this is our term, this notion of the bits to atoms trade has produced its share of losers thematically over the last while too. We've talked about that on the podcast with other guests, but clearly we have some of that exposure within the U.S. mid-cap portfolio as well.
And we will continue to have some of that exposure. And for those of you who listened to me speak in the past, our kind of viewpoint when constructing portfolios is one of creating inherent contradictions. So while we think about all these themes, it boils down to a bottom-up basis, which is, well, okay, if this company has, it doesn't even matter at that point, like exposed to a theme or so on, but just if we believe this company has growth for the next 5 or 10 years greater than GDP, when we put that in our discounted cash flow model, this company looks more attractive now, all else being equal from a valuation standpoint. And so that would kind of cause us to lean in that direction. But at the same time, we will say, okay, well, if the particular theme you're exposed to is AI data center buildouts, and that's what's causing your revenue growth to be maybe higher than GDP, if AI doesn't generate the productivity booms, or at least not as much as people expect, then perhaps we need to also buy a company whose growth will be hurt by very, very productive AI. And relative speaking, will do better if AI turns out to not be as transformative as some people think it will be. So a good example of kind of what's colloquially termed an AI loser would be a professional service company or a software company, where if AI becomes amazing, it could just create a brand new software program in like 2 hours and be just as good as SAP or something like that. And if you're in that camp, then well, you probably sell SAP and you buy something in the AI data center complex, or even if and when they become public, the AI model companies. But our view has always been one of inherent contradiction. So we're not trying to quote unquote bet on a theme, even though we spent the entire podcast talking about kind of themes that we are seeing or thinking about. We're trying to keep a balance, and not in a kind of a head in the sand way, which is like, okay, it's becoming more and more obvious that AI is highly productive, and unreleased AI models is able to hack into like any bank in the world now, apparently. So like we're not immune to, or not immune, but they're not like putting our head in the sands and ignoring comments like that. But rather we're saying these other companies over here, they are wealth creating companies. Some of them, I mean, many of them genuinely face AI threats, and we've actually exited a couple companies in our portfolios because we view those threats as pretty existential, at least kind of thesis altering. But we're just saying, yeah, there's a lot of kind of babies being tossed out with the bathwater these days in AI losers bucket. And so we have kind of picked away at it, and we've actually added some companies to the portfolio that kind of fit in that category as well. And so ultimately, our goal is to create a broadly diversified portfolio of idiosyncratic ideas on behalf of our clients. And there should be companies that have inherent contradictions. And if it's a period of time where companies that, let's say, benefit from AI developing faster and faster, maybe they just look really attractive on a bottom-up basis, then maybe the portfolio will have a little bit more of that. But that's a bottom-up stock selection process. And where the top-down kind of overlay comes in is, even if we find all these great bottom-up ideas in kind of, say, AI CapEx or AI beneficiaries, we want to make sure that the weight of that bucket doesn't get so large that we become unbalanced. And so, yeah, hopefully that makes sense in terms of kind of how we're thinking about just.
I think it does. I think it also partially helps to answer a question that I promise to come back to, which is like, okay, where might you be wrong on this particular theme? And I think you've answered the so what as to what you do about it is you don't bet full in on this theme. You just make sure you have the appropriate awareness. You're still looking from a bottom up basis, but in a world that has become extremely thematic. I mean, I see this in conversations with clients. Like all we talk about are themes. It seems like the market is moving very much in themes. That awareness is just that much more important. Jeff, can I ask you one last question before we wrap up, which is, um, if you agree with the premise that over the long term, um, stock prices should follow genuine wealth creation. What does this all say about the ability to generate wealth as an economy for our standard of living, but just in individual investments looking forward?
At a economy-wide level, we're still pretty optimistic for the economy for the future. Many have described this AI boom as the most significant boom since the internet boom. And at the time, it kind of seemed gimmicky, and anything with like a .com attached to the corporate name suddenly was trading $1 billion higher. Um, and then there was a crash, and there was kind of a lot of I told you so, though that was kind of not very helpful, or that especially the Luddites all came out and celebrated. But 25 years later, like pretty much everyone in the world's like, yeah, I can't live without the internet at this point. It's completely transformed the economy, completely transformed their lives. When I travel into like the mountains of India and Indonesia or somewhere, like, yeah, there's people with smartphones, on Facebook, and following the memes of today. By the way, memes actually, I would say, is driving markets more than themes these days, but I'll put that aside. I would say at the core of it, it's still a solid economy, and there's still a huge productivity gain coming from this new technology. How much of that productivity gain will ultimately be achieved is actually not about the technology, in my opinion. I think it's about the adoption.
Thank you so much for this conversation. I know we covered a lot of ground, and it's given me a lot to think about going back. But I also think it's just a wonderful example of what the life of a portfolio manager looks like. Contemplating a bigger picture theme, really trying to understand all the drivers and the angles, what the other side might be, where you might be wrong, and then going back to the bottom up and understanding exposures within portfolios, what might benefit, what might not, having some contradictions. And then, like you said at the end, being super humble about one's lock on that degree of knowledge. So, Jeff, thanks so much for taking the time to walk through that with us, and look forward to having you on again soon.
Thanks, Rob.